In early August, UOB agreed to sell its 4-decade-old asset management arm, UOB Asset Management, to align a modest lift to its capital ratio. The business carried around 42 billion Singapore dollars in assets, some 500 in staff, and the deal closes in 2027. Stripped of the numbers, the transaction is a statement of identity. UOB is exiting product manufacturing to stand exclusively on the advisory and the open architecture distribution. And it's keeping the long-term partnership that leaves Alliance GS products on its shelves. Now, the instinct is to read this as a retreat. However, it is closer to specialization. The wealth value chain has 3 particular layers: manufacture the product, distribute it, and advise on it. And each carries different economics, different capital intensity, and different competitive moat. UOB has concluded that its edge is in the client relationship and not the factory that stamps the product. It would rather own the shelf and conversation than the balance sheet behind the fund. Hello, everyone. Welcome back to our channel and welcome back to another edition of Capital Insights. This series sits within our fundamentals to the noise, and today we wanted to focus on the asset management consolidation that is happening. We wanted to share with you the race for permanent capital and who really owns the balance sheet. Singapore's UOB is walking away from making investment products to concentrate on selling them. That choice, capital light, distribution first, is the mirror image of the largest structural trade running through the global asset management, the race to own manufacturing scale, and beneath it, permanent capital. This particular video and this note maps who is seizing which end of the value chain, why the economics compel the split, and where the newly consolidated product goes next. Let's first start with the trigger. In early August, UOB agreed to sell its 4-decade-old asset management arm, UOB Asset Management, to Alliance Global Investors for roughly 555 million Singapore dollars, booking a pre-tax gain of approximately 330 million and a modest lift to its capital ratio. The business carried around 42 billion Singapore dollars in assets, some 500 in staff, and the deal closes in 2027. Stripped of the numbers, the transaction is a statement of identity. UOB is exiting product manufacturing to stand exclusively on the advisory and the open architecture distribution. And it's keeping the long-term partnership that leaves Alliance GS products on its shelves. Now, the instinct is to read this as a retreat. However, it is closer to specialization. The wealth value chain has 3 particular layers: manufacture the product, distribute it, and advise on it. And each carries different economics, different capital intensity, and different competitive moat. UOB has concluded that its edge is in the client relationship and not the factory that stamps the product. It would rather own the shelf and conversation than the balance sheet behind the fund. Now, this is what sets the question that this video is answering. If a competent regional bank is content to hand over manufacturing, someone is paying up to take it. And the identity of that someone and the structure they're using to buy it tells you where the industry's economics are migrating. The buyer here was not a rival bank. It was the asset management arm of a global insurer. That detail is the whole story in miniature out here. And this brings us to the squeeze that is forcing that choice. Now, for a decade, the fees in public and private strategies have been ground down by the index products and scale distribution. The economics of running a tracker reward only the very largest. Per dollar margins are wafer thin, so absolute profit depends on enormous, ever-growing asset base spread across a fixed cost of research, compliance, technology, and distribution. Below a certain size, the model simply does not clear. Now, that leaves the mid-size active manufacturers stranded in the dead zone. Too small to win the razor margin passive game, too undifferentiated to command the premium fees that justify active management. And the assets under management for UOB are at roughly 42 billion Singapore dollars, and it's the archetype of the stranded manufacturer. Respectable, regionally credible, and structurally subscale against a manager that runs trillions of dollars. For a business in that position, there are only 2 exits. The first is to become enormous, converting fixed cost leverage into margin by piling more assets onto the same platform. The second is to move up market into private assets wherein fees have not been compressed and a manager can still charge a genuine scarcity and skill premium. Nearly every consolidation move in the market is one of these 2 escapes. The most ambitious players are executing both at once. And to see who sits where, it helps to plot the field on two axes, where a firm sits in the value chain from distribution to manufacturing and how it funds what it manages, from third-party money to owned permanent capital. And this brings us to the three archetypes of consolidation. Placed on these two axes, the recent wave of deals resolves into three recognizable archetypes and one revealing empty escape. The first archetype is the insurer-owned manufacturer. Alliance is the cleanest example. Through PIMCO and Alliance Global Investors, it runs roughly 2.2 trillion euros of third-party assets, and it sits atop close to 800 billion euros managed for its own insurance book. The UOB Asset Management purchase is a bolt-on to that machine, and the pattern repeats across Europe. BNP Paribas' acquisition of the EXA Investment Managers, completed in mid-2025 and folded into roughly a $1.8 trillion platform by year-end, was executed by BNP Paribas Cardif, the group's insurance arm, and not the bank. Atlas Generali has also attempted the same logic through a planned combination of its investment unit with BPCE's Natixis, a would-be 1.9 trillion euro European champion, though the transaction has stalled on cross-border political friction. In each case, an insurer is reaching for asset management capability. The second archetype is that of a pure-scale manufacturer. BlackRock has spent north of $24 billion in acquiring global infrastructure partners, and the private credit manager HPS, plus a further $3.2 billion for the data provider Preqin, an explicit campaign to shift its revenue base towards private markets, expected to lift the private market fee-paying assets by around 40% and management fees by roughly a third. Amundi, Europe's largest manager, plays the same game from a traditional bank-owned base. These firms manufacture at large scale, but on third-party capital, and they have no insurance balance sheet of their own. The third archetype is the inverse of the first. The alternatives manager, they bought an insurer. Apollo pioneered it with Athene. KKR completed its buyout of Global Atlantic in early 2024, watching that balance sheet compound from $72 billion to roughly $158 billion. Same logic, the reverse direction of travel. Instead of an insurer acquiring investment capability, an investment firm acquired permanent capital. Now here's an exhibit that shows it all. Three readings fall out of the map. First, the empty quadrant is the argument. No one distributes on permanent capital because the moment a firm holds locked up insurance money, it needs origination to feed it, which drags into manufacturing. Secondly, the barbell. The whole reordering is a migration along one diagonal, from UOB's light, third-party advice-led corner to the heavy-owned capital, origination-led corner. UOB is not failing. It has chosen the opposite pole of the same axis that these acquirers are climbing. Thirdly, BlackRock is definitely an outlier. The one giant manufacturing at scale on purely third-party capital, buying its way towards private markets without an insurance balance sheet of its own. Whether that is discipline or exposure is genuinely an open question for now, and the credit cycle will be answering it. And this brings us to the permanent capital engine. Why insurers specifically? Because insurance float is the ideal fuel for the assets everyone wants to manufacture. Premiums held against long-dated liabilities are patient, locked up, effectively permanent capital, and private assets being illiquid need exactly that. Long-duration liabilities matched to long-duration assets solve the horizon problem that plagues conventional fund structures, wherein a closed-end vehicle must realize its holdings inside 7 to 10 years, whether or not the moment is right. Apollo and Athene expose the mechanics without decoration. Apollo earns a management fee on the asset it runs for Athene and originates the private credit that fills Athene's balance sheet, collecting both a fee and a net investment spread on the same dollar. Roughly 9/10 of Athene's assets are policyholder liabilities functioning as float deployed into proprietary credit. That double engine, funded by capital that never redeems, is the price that the entire industry is now chasing, whether it approaches it from the insurance side or from the alternatives side. The winning structure is the same from either direction: an origination engine, a permanent balance sheet, and a distribution shelf collapsed into one single group. This is why the top right of the map wins and why the buyers are the insurance arms rather than banks. It also explains the quieter deals filling out the pattern. A large US life insurer absorbing a traditional manager, another acquiring a controlling stake in a direct lending specialist. Everywhere, insurers are buying credit origination capability and alternative managers are buying permanent capital. The line between the two businesses is actually dissolving. Which brings us to the major question of what are they actually selling? Consolidation is only half the trade, and the other half is what the enlarged manufacturer sells and to whom. Upward to sovereign funds and family offices, the pitch is integrated access to public and private markets on a single platform, increasingly bundled with data and technology sold as its own mode and its own product. And when we talk about downward, it's to the wealth and mass affluent channel. The pitch is democratization of alternatives, semi-liquid private credit vehicles, model portfolios, and still forming frontier of private assets inside the retirement accounts. And the fee ladder here that you can see in the exhibit is why the manufacturers climb into the private markets. That gradient is the entire commercial logic of the consolidation wave. A firm that shifts even part of its asset base from the tracker into the private credit is not only improving its margin at the edges, it's also repricing the book. But the manufactured product still has to reach a client, and that is precisely the half of the chain that UOB has elected to keep. The distribution partnership staple to the UOB asset management sale is a handshake across the split. The manufacturer gains regional shelf space, the distributor gains a broader product range, and neither carries the other's cost base. Open architecture, seen this way, is not an ideology. It's actually a settlement between a factory that no longer wants a storefront and a storefront that no longer wants a factory. And let's also discuss the tail risk. The machine runs on two assumptions: that spread stays wide and that the underlying credit stays money good. Both are cyclical. Apollo's own long-range figures model a net spread that compresses meaningfully over the coming decade and a real default cycle, not benign conditions in which the model was built. This is still untested stress on the whole edifice of permanent capital funneled into illiquid private lending. The efficiency of matching locked-up liabilities to unlisted assets is real, so is the fragility of marking those assets to a downturn when the liabilities cannot be redeemed but the borrowers can still fail. The regulators are leaning in accordingly. Insurance capital is scaled to portfolio risk, and acquirers are absorbing measurable hits to their capital ratios to complete these deals. Supervisors across US and Europe are scrutinizing the insurance and private credit convergence precisely because it concentrates so much in single hands. And that concentration is a deeper risk that the map implies. As origination, balance sheet, and distribution collapse into one group, the linkages that make the model efficient are the same linkages that make it correlated. A structure optimized for capturing fee and spread on every dollar is, by construction, a structure with fewer fire breaks. And let's wrap up this video with the tokenized handoff. The reordering does not end at who owns the factory. The manufactured product, funds, private credit, and in time, the tokenized representations need a servicing and settlement layer, and that layer is itself being contested. Herein, we'd like to stress that Singapore, having watched one of its banks trade manufacturing for distribution, is positioning to be the servicing hub for exactly this consolidated product. The tokenized asset and wealth management workstreams now forming under its market infrastructure initiatives are, in effect, a bid to sit downstream of every manufacturer in the map above. Now, that is the theme that will follow on into our next video. Having established who owns the balance sheet, the sequel really asks for who owns the rails beneath it, the settlement and tokenization infrastructure being built for the very product that this wave of consolidation is manufacturing, and the fragmentation contest playing out around those rails. The factory has a new owner, as we have shared with you. The question is whose plumbing carries its output, and it's still open. That's all that we wanted to share with you in this video. Hope you've enjoyed the video. Stay tuned in for our next one.